Good afternoon, ladies and gentlemen. We're going to start. The Governor, unfortunately, is delayed in traffic, but he'll join us soon. So welcome to the release of the Financial Stability Review. We've made a few changes to the format of the event. We still call it the Financial Stability Forum, and this is where we share the bank's assessment of financial stability developments and trends, and we would like to discuss it with you and also enhance debate on the issue. So we brought the forum to you, and now we're experiencing the traffic problems. So we'll have to reconsider this carefully. But I would like to share the program with you. But before I do that, the panel on my left-hand side. Hopefully the Governor will join us, and then we have Kiben Naidu, who's Deputy Governor and CEO of the Prudential Authority, Rashad Kasim, who's responsible for financial stability as the Deputy Governor, and then Fundi Shasibana, who is responsible for financial markets and international. And then on the far end, Videshri Ruplal, who will be doing the presentation today. So the program will be changed slightly. We won't have the opening remarks. We'll probably have closing remarks at the end from the Governor. So we're going to go straight into the presentation by Desh. Copies of the publication will be available as you leave the room, and then you're also invited to a cocktail after we finish here. Desh, over to you.
Thank you, Hendrik, and good evening to the Deputy Governors and distinguished guests. So the outline of today's presentation, so overall we did find the financial system to be strong and stable, and despite some global and domestic headwinds. So today's presentation will focus on some of those global and domestic headwinds. So some of the sectors we will discuss today are developments in the sectors in financial markets, economic growth, banking sector, non-financial corporates, households, and government debt. So there is some good news in some of the sectors, which is quite encouraging. And then just our standard risk assessment matrix, which we normally publish in the review. And then we'll conclude with overall remarks about the stability of the South African financial system. I would just like to also point out that there are 4 boxes in this edition of the FSR. The first one is downside risks to growth. So it's growth at risk estimates for South Africa. So what we did there is we adopted IMF methodology, growth at risk, and we applied it to South Africa. So this model basically looks at the impact of financial conditions on economic growth. Most literature is actually the other way around, is quite established. So we found this to be quite interesting. And then the other box is steering towards a green economy. There has been a tick up or acceleration in household unsecured credit in South Africa. So I'll talk more about this in the slides, and there's a box on it as well. And then cyber risks and the financial sector. So this is also one of the risks that we have identified in the risk assessment matrix. So moving on, so during the period under review, global financial markets were volatile. So that's in the 6 months, although historically volatility levels have been low. So this is largely due to global financial conditions that have eased based on expectations of additional monetary policy accommodation in advanced economies. So that's because of slowing growth concerns and global trade tensions. So on the global scene, there has been synchronized slowing in growth amongst mostly advanced economies. We saw risk measures. So if you look at the left graph, such as the MOVE index. So the MOVE index measures advanced bond volatility. The VIX index that looks at equity market volatility. So these measures initially deteriorated, but once accommodation measures were applied by global central banks, we did see some sort of decrease in risk aversion. So in terms of the outlook for global interest rates, the expectations, if you look at the graph on the right, going forward, there are expectations for central banks to carry on the accommodative path, although it has been limited. So here you look at comparing the blue lines to sort of the yellow lines, and you can see a lot of central banks are expected to embark on accommodative measures. So in terms of where we are at the moment, so it is a paradigm of low interest rates for longer. So what does this mean for South Africa as an emerging market and other emerging markets? So as much as accommodative measures in the short term can offer some sort of reprieve in terms of stability in riskier assets, in the longer term, maybe not so. As we've seen previously, during long periods of accommodative monetary policy, there is a build-up of financial vulnerabilities. So from an emerging markets point of view, and South Africa being a deep and liquid emerging market, it does present some sort of risks. So when there's a build-up of vulnerabilities, there can be a repricing of risk, because in the search for yield, investors do tend to take on riskier and more illiquid assets. So for South Africa, in that sense, it is a risk. Domestic markets did track global conditions that I've spoke about in the previous slide, but were further affected by negative local risks. So this is the prolonged period of economic growth that we've had, low economic growth on the one hand, and then the fiscal conditions that have been deteriorated during the period under review. So if you look at the CDS spread of South Africa in the context of the ratings agencies that are looking closely at us, you see South Africa's CDS spread has been trading along the lines of markets or some market participants largely anticipating or pricing in a downgrade, further downgrades, particularly Moody's. But that being said, if you look at this in the context of the uncertain global environment, one should not guard against complacency, even though it's somewhat priced in, because given what's happening on the international scene, and especially with the emerging markets risk aversion, there could be asset price losses and capital outflows in the event of a Moody's downgrade. In terms of South African markets, if you look at the right, so the rand did depreciate during the period under review. At one stage, it weakened by 6% against the US dollar, and it was also trading in quite a wide trading range of about 13.81 to 15.50, and that was against the US dollar. Domestic bond yields were also pressured by the deteriorating fiscal position in South Africa, but for the year-to-date, yields are lower, so that's more in line with the global yield environment on the back of easing financial conditions. So this is the box that I spoke about earlier, box 1, where we applied IMF methodology, growth at risk, to try and anticipate or evaluate the impact of global financial conditions on economic growth. So the methodology is described, more detail is given in the box, but just high level in terms of the results. So the IMF results show that, so we're looking at the red line and the blue line. So in the near term, you'll see growth just over 2%, so it's global growth from the IMF. So in the near term, the accommodation measures that have been put in place by central banks have actually, the IMF states that it's helped near-term growth. So you can see more in excess of 2% is expected. But in the more medium term, the red line, you can see growth is expected to drop a bit. So we did apply this model to South Africa. The results are a bit different. It's the opposite actually. So if you look at short-term or near-term growth, it's expected to be negative 0.2%. That's the blue line, and then medium-term growth ticks up to just over 1%. So South Africa has to deal or contend with international risks on the one hand, and then our idiosyncratic risks on the other hand. Moving on to the banking sector. So this is a good news story for the banking sector. Impaired advances as a percentage of loans in advances has moderated since its peak in January 2019, earlier this year. So that's the red line. So our overall analysis in the banking sector suggests that although there are selected risks that have the potential to lead to vulnerabilities that could amplify shocks to the system, we do not view any of the shocks or risks in the banking sector to be systemic in nature. So specifically, the overall trend in the ratio of impaired advances to on-balance sheet loans has stabilized following the strong upward trend that we witnessed, and that was on the back of the International Financial Reporting Standard in January 2018 when it was reduced. So this moderation that we see in impaired advances as a percentage of loans and advances largely due to slower growth experienced in impaired advances between January to August, and that compared to an increase in on-balance loans and advances over the same period. South African smaller banks, so also showing improvement. So profitability is quite an important contributor to the sector's ability to generate capital in order to have sufficient buffers in the event of a shock to the financial system. So this slide provides an indication of profitability in the banking sector over the last few years. The left graph shows the return on equity and return on assets of domestic banks. And if you look at the dotted red lines, you see the ROE and the ROA of the 5 largest banks quite closely correlated to that of the total banking sector, explaining its dominance. On the smaller banks, you do see that there was a strong downward trend observed in the ROEs and ROAs. So that would be your green solid and dotted lines. So that's what we reported in the previous FSR. But since then, there has been an improvement in the side, which is quite good. But that being said, in times of tough economic times, it's the smaller banks that actually face more strain than the bigger banks. That's because of the lack of flexibility in their cost base, and also their lack of or less diversified income sources. On the right-hand side, the smaller banks' operating profit, we also saw a contraction there for smaller banks, and in the last 6 months or so, the red line, you can see that's also picking up quite a bit. So the banking sector, we see it as stable, and the smaller banks have shown some improvement or moderation after contracting in certain categories. So we move on to the South African non-financial corporate sector. So debt levels do remain historically elevated, if you look at the graph on the left-hand side. So particularly since 2015, there's been an increase in the take-up of debt. It is currently below that of its international peers, but historically it's still high, and it is of concern. So as at the second quarter of this year, SOE debt accounts for 39% of the sector's total debt. The foreign currency portion of non-financial corporate debt, so that accounts for just over 40% of the total sector debt, as at the second quarter of 2019. So that's the red bit. So this increase or debt accumulation has been largely associated with the weaker exchange rate of the rand. So the sector is exposed to currency risk on the one hand, but on the other hand, it's also exposed to refinancing risk, since should global interest rates rise. Although at the moment, your looser global monetary policy is a mitigating factor at present. So while a significant portion of this, just over 60%, is still rand-dominated, refinancing risks also pose quite a risk as well, given that they also reflect prevailing domestic economic conditions. So another measure we look at is the ability of corporates to generate cash to pay off debt. So more detail is in the FSR giving a description of it, but it's the interest coverage ratio that we look at. So as mentioned, it does estimate an ability of a firm to generate cash to pay expenses. So according to the IMF's methodology, firms classified as weak are those firms with an income that covers interest expenses by less than 2 times. So it's a little yellow dotted line that we see there. So firms above the 2 level are regarded as stronger or in a better position to pay off debt than firms below the critical 2 level. So for the period under review, if you look at that extreme left line, the yellowish or mustard line, you can see as an aggregate for the industry, the ICR has remained, although it's deteriorated slightly in 6 months, it's remained above the 2 level, as has some of the other industries, but the critical ones to look at are those below the 2 levels. So that would be your transport, storage and communication, and your electricity, gas and water. And you can see business services quite close to the 0 as well. So if you look at this in isolation, it doesn't mean much. So what does this mean if it's below, whether it's below or over 2? What does this mean for the South African banking sector? So the right graph shows that the banking sector is largely exposed to non-financial corporates. So there's a 36% weighting there. But if you look at in context of the left graph, where I pointed out that the ICRs of the transport, storage, communication, and electricity, gas, and water are below 2. The banking sector's exposure to these sectors are actually quite low. So I don't have the table here, it is in the FSR, but it's 2 and 3% respectively. So if there has to be further weakening in the ICRs or the ability of non-financial corporates to pay off their debt, we don't see significant weakening in the banking sector due to low exposures to these weak sectors. The next slide focuses on the household sector. So indicators such as income and debt are very important for financial stability because these sectors, the household and the non-financial corporates, represent some of the main clients of the banking sector. So a highly indebted household sector is a cause for concern because households are sensitive to shocks in the system. For example, sudden increases in prices or interest rates. So high debt levels tend to decrease the ability of households to pay off debt, and then it increases the probability of defaults and has a ripple effect and causes deterioration in banks' asset quality and ultimately bank profitability. So if you look at the table, so we can go back a few years as well, but in the table we look at 2018 versus 2019, you can see the deterioration in disposable income and the rest of it as well. So credit extension also ticked up from 4.5% quarter 2 2018 to 6.2%. And obviously when there's an increase in debt, decrease in income, you will expect debt service costs as a percentage of disposable income to also deteriorate. So the past few years, household income levels have been constrained by the lower economic environment, and the growth in disposable income has deteriorated as well. So if household debt does continue on its upward trajectory, it does pose risks for the consumer, and as I've mentioned, the debt servicing costs. So overall, the household sector remains vulnerable. It hasn't been it's not at its weakest point, but given where we are against the global backdrop and deteriorating economic growth, households are vulnerable. So we will continue to monitor these risks, especially in context of the low economic environment. So in the previous slide, there was an increase in credit extension. So since 2017, we have seen an increase in household unsecured lending. So that's especially 2017, but particularly this year, it's taken up quite a bit. So in prior years, there was a bit of stability or stabilization between 2013 and 2017. So that was following the failure of African Bank and the introduction of the National Credit Regulator's affordability assessment, but it has since picked up, which is something we will continue to monitor. If you look at the graph on the right, it's the household non-performing loan ratio, and if you focus on the red line, you can also see the increase there. So this is just an indicator that households are struggling to pay off their unsecured debt. So one of the risks that we have in the risk assessment matrix, which we view as critical or possibly systemic within the projected 12-month period, is the government finances. So almost all of the government debt metrics have showed further deterioration over a period of time, but also during the 6-month period. So government finances and sustainability of government debt has negative impact on investors' views on the sovereign's credit worthiness. So this can result in refinancing difficulties and ultimately trigger wider financial system instability. If there's a belief that public finances are unsustainable and vulnerable to shocks, the risk premium on debt could increase, and it could lead to higher interest rates, and then you get higher debt servicing costs, and there's a ripple effect, increased rollover risks. So higher levels of public debt can increase the probability of the prices of other assets also decreasing. So the importance of government finances to financial stability is quite critical because of the ripple effect. So presently, deteriorating government finances are seen to be one of the possible main triggers for further sovereign credit rating downgrades. So it's the increased and continued reliance of SOEs, state-owned entities, on state funding that has impacted severely on the country's finances. If you look at the total stock of contingent liabilities, it is expected to exceed 1 trillion rand by 2021, and of this amount, the government guaranteed portion has increased from 670 billion, so that's in 2018, to 683.3 billion in 2019, of which Eskom received 350 billion rand. So Eskom's had quite an impact on the country's finances. So the growth of South Africa's contingent liabilities, coupled with other idiosyncratic factors, have triggered concerns of increased vulnerabilities and deteriorating finances going forward. So the weak performances of SOEs are quite critical, and it has drawn increased state support. So if you look at the graph on the left, you can see those SOEs that have relied on state funding, and obviously Eskom being the dominant force there. The graph on the right, so this was taken from the medium-term budget policy statement. It does show that Eskom's share of the debt, the impact it has had. So you can see the projections, the government debt projections with Eskom and without Eskom. So with Eskom in the picture, debt is projected to increase to close to 80%. And we will, so some of us are aware that the IMF, so they describe Eskom as a macro-critical entity, and they regard 70% as a high-risk threshold. So against this backdrop, a lack of fiscal consolidation and worsening in government finances does remain a key risk to the sovereign credit rating. We've already seen Fitch a few months ago change the outlook to negative, so that's already on sub-investment grade. We've seen S&P move last week, so and then we've also seen Moody's change the outlook to negative, so that's on investment grade. So these sort of numbers are critical going forward. The medium-term budget policy statement was viewed or perceived as being credit negative, so we'll just have to see. So I know the Eskom results were out today. I haven't looked at it, but that also quite will give us some insight in the future debt trajectory. So this slide links onto the previous slide, where there are increased risks of further rating downgrades. So we turn to developments on bank funding costs, and here we look at the overnight wholesale deposits on the left. So that's your SARB repo spread. And then we look at the interbank funding spreads on the right. So many of you may be aware that South Africa's risk premium has been rising, as has the bank's risk premium. So the bank's risk premium is measured as an average of the major bank CDS credit default swap spreads over the sovereign. They have been steadily increasing, although it is stable at the moment. So that's the blue line on the left. And on the right, we just put the domestic interbank funding rates. So the point I want to make here is that there's already been a steady increase in funding costs of banks. So this does set the scene in the event of a sovereign credit rating downgrade. So the impact could be quite negative, and funding spreads could increase through quite a lot. But at the moment, there have been no spillover effects to domestic financial conditions for banks, and it's not reflecting in banks' balance sheets as well. But in the event of a downgrade, obviously, the situation would change. So from a financial stability point of view, we are watching this quite closely. And then the next slide, before we move on to the risk assessment matrix. So the counter-cyclical capital buffer, CCYB, it is one of the macroprudential policy tools or instruments of the SARB. So for those who are not familiar with the CCYB, it provides macroprudential supervisors with a tool to change capital requirements for banks in order to protect them from boom and bust phases of the financial cycle. So according to arrangements for the minimum requirements of Basel III, the CCYB could be applied to banks in South Africa from 2016 if required. At the most recent meeting of the Financial Stability Committee, that was in October this year, and in fact from the inception of the CCYB in 2016, the decision has been made to keep the CCYB add-on for banks at 0%. So the justification for this decision has been that the credit to GDP gap has widened, but it has remained negative since 2011. So on that left graph, it's a blue line in the bottom. And if you look at the sectoral sort of separation on the right, households and corporates, you can also see that credit growth has remained below its trend, although for the corporate sector, it's sitting right on that line. So we just thought we'll mention this to you because it is one of the macroprudential tools that the bank has at its disposal. So finally, we get onto the risk assessment matrix. So after looking or assessing the financial system for the last 6 months, taken into account global developments, we have identified 4 risks on our risk assessment matrix as being potentially systemic within a 12-month horizon. So the risks that we do rank, they are rated according to the likelihood of their occurrence as well as expected impact on the domestic financial system. They are classified as high, medium, or low in terms of both the likelihood of each risk materializing and its possible impact. So in this FSR, we do highlight that. So the first risk, or the first 2 risks on the domestic side, we've identified as the deteriorating domestic fiscal position, and that's on the back of what I've explained. So it's deteriorating debt fundamentals, fragile positions of SOEs that are contributing to additional pressure on the fiscus. The second risk is rising cyber dependency. So that's due to increasing digital interconnectedness of people, systems, and organizations. So some of the risks there that you can have is ransomware, targeting of critical infrastructure, strategic industries. So the impact of all of this is you could get a reduction in profitability if some of the operations are quite negatively affected. We've spoken about the weaker global economic growth and spillover to South Africa. So that's emanating from slowdown in global growth, the escalation of trade tensions, continued policy uncertainty, and then geopolitical factors such as uncertainty on the Brexit outcomes, downward pressure on the Chinese economy, and other geopolitical events such as affecting energy prices. And then the last risk on the international or global scene is abrupt and unanticipated changes to global financial conditions that affect emerging markets. So we've spoken about a repricing of risk if there's sudden adjustments to monetary policy, and the fact that the lower for longer paradigm can increase vulnerabilities for emerging markets, such as South Africa, where you can tend to take on or search for yield and take on investment in riskier assets and also illiquid assets. So overall, despite the headwinds that I've spoken about, domestic and international, our conclusion is that the financial system remains strong and stable. And it's also well characterized by highly regulated and capitalized liquid and profitable financial institutions. So that would be our overall assessment. Thank you.
Okay, thank you, Desh, for that overview of the highlights of the report. So welcome, Governor. I'm glad you made it safely. And I'm going to give over to you for introductory remarks and do some closing remarks for us. Thank you.
Nothing introductory, Hendrik. Dash has done a good job. We had to come to Joburg, and after I got caught in the traffic, I now know what you go through trying to come to the central bank. But just to tie up on what Videshri has just said, and a few takeaways in terms of the vulnerabilities. Clearly, the issue of weakening economic activities and increased downside to the global economic activity and activity in the advanced economies had actually prompted many central banks in the advanced economies to begin accommodative monetary policies once again. And then with this, though, what we had seen is that it had encouraged financial risk-taking, and this could actually fuel a further build-up of vulnerabilities in some sectors and countries. And any abrupt and unanticipated changes in global financial conditions may impact on emerging market economies. Of course, these accommodative monetary stances in the advanced economies, which are had meant that we continue to see low interest rates, had led to a situation where people are starting to talk of low forever. And the view that we have taken says, no, it can't be forever. I'm sure it can be low for longer, but you surely cannot say low forever. This low interest rate environment had led to an increase in capital flows to emerging market economies. So the increased risk-taking is not just taking place within sectors in the advanced economies. You have also seen the flows actually finding their way to emerging market economies. That meant that debt in emerging market economies also started to build up. The median external debt in emerging market economies has increased to 160% of exports from 100% in 2008. So any sharp tightening in global financing conditions will increase rollover and debt sustainability risks. South Africa is still in a pretty a good space. In South Africa, total foreign debt represents about 153% of total export earnings, well below a ratio of 300% measured in some other emerging economies. But also, the foreign currency share of non-financial corporate debt accounts for about 40% of the sector's total debt. And of course, what is also even more heartening, in spite of our debt, our sovereign debt rising, foreign currency denominated debt still represents just around 10% of the gross sovereign debt, posing very little refinancing and currency risks to the South African sovereign. This does not mean, though, that we would not be affected by a certain tightening in global financing conditions, as even the debt that we have that is denominated in domestic currency has got a significant chunk, just over 35% of it being held by foreigners. Just a month ago, we were at the annual meetings of the bank and the fund in Washington, and one of the things highlighted during those meetings had been rising corporate sector vulnerabilities as a result of rising debt burdens and weakening debt service capacity. Debt owed by firms, according to the GSFR, Debt owned by firms unable to cover their interest expenses could rise to 19 trillion US dollars globally, well above the pre-crisis level. So corporate debt levels have also increased in South Africa, and affordability measures point to a weakening in the sector's ability to service its debt. But like I said, the fortunate thing in South Africa is that only 40% of the corporate debt is actually denominated in sovereign currency. One of the things that also came during the meetings in Washington had to do with the over-indebtedness of state-owned entities, which is becoming a growing concern globally. So if you wanted to know what's the biggest piece of good news in terms of the financial stability risk, is that the good news are that South Africa is not alone in terms of over-indebted state-owned enterprises. But the thing in our case is that the debt of state-owned enterprises is starting to play itself into sovereign risks and is starting to fit itself into the country risk premium, and this could actually pose a risk and precipitate sovereign ratings downgrades, which could trigger capital flows and excessive financial markets volatility. So let me just round up and just restate that since the global financial crisis, the core of the global financial system is more resilient than it was in the run-up to the global financial crisis. However, there are still pockets of weaker institutions that remain. The more subdued global outlook has reduced expectations of bank profitability, and market capitalization has fallen for some of the banks. In contrast, the South African banking sector remains sound, profitable, and is well capitalized despite being confronted by an extended period of low economic growth. There's been a modest increase in banking sector credit growth, mainly due to increased lending to corporates. Impaired advances have moderated since January 2019 and remain low despite trending upwards. I am stating this and just re-emphasizing these things because they got captured in Videshri's presentation to say that in spite of all this negativity and the vulnerabilities globally, one of the things that we could still, as South Africa, talk about is the fact that our financial system is actually as resilient as it is. Last year, the Financial Sector Regulations Act came into effect, and in terms of Section 29 of that Act, the governor may designate financial institutions as being systemically important. There is a process that is outlined in the Act, which we have followed, and I gave notice to the Financial Sector Oversight Committee of our intention to designate 6 South African banks as SIFIs. All the 6 banks have accepted their designation, and that would be Absa, Standard Bank, FirstRand, Nedbank, Investec, and Capitec. Designation as a SIFI does not mean that these banks are seen as relatively riskier institutions, but that given their potential systemic impact, it is important for the SARB to monitor their operations and soundness from a macroprudential perspective, in addition to the microprudential regulation and supervision conducted by the prudential authority. So that is what we had captured, and you will also find in the financial stability review that for the first time we had highlighted potentially the risks from climate change to the financial sector. This is an area that central banks are just beginning to grapple with. And just to be clear, that the issue of climate change is the responsibility of elected officials of government. The only interest that we have is what does the risks of climate change pose to the financial sector. And to familiarize ourselves and exchange knowledge with other central banks. We have joined the network for greening the financial system. And going forward, we will continue to monitor the risks associated with climate change and the risks that it poses to the financial sector. So let me leave it there and take questions. And if there are any questions that have to do in particular with the banking sector, I would like to start with those because Deputy Governor Naidu must go back to school. Nothing. Okay, then we are open for all other questions. Right here, the third row. There's something wrong with this first row. Nobody wants to sit in it.
Governor, this is Lynley from the Business Day. The reviews period was between January to June, if I'm not mistaken, and definitely in the last few weeks, I think in the last few days, we've seen increased worry around the sustainability of SOEs, particularly like of SAA, and you would have, I'm sure, seen Eskom's results today, which were very negative. I'd just like to understand your thoughts on the possibility of a SOE corporate failure and what you think this would mean for the financial system. And then secondly, similarly, in the private sector, we have had a couple of very big companies doing very, very badly. I think of Steinhoff, I think of EOH, I think of Tongaat. What do you make of the possibility of corporate failures in the private sector and their possible impact on all of this?
No, the review does not cover from January to June. If it only covered January to June, we wouldn't have incorporated the medium-term budget policy statement. So the first edition dealt with the first year of the year, and this one deals with the second part of this year. So Deputy Governor Naidu, we have stress-tested the banking system for a failure of a significant SOE. If you could deal with that question, and then once you have answered that, in no time you will be back at school.
Okay. I will deal with banking sector exposure, SOE to the SOEs. Financial sector exposure to the SOEs is far larger. The second point I want to make is that if there is a default and the state doesn't take over that debt, it is seen as a default of guaranteed debt. That could have much broader implications. So I'm going to answer the question as narrowly as I possibly can. Total banking sector exposure, South African bank sector exposure to the SOEs is 129 billion rand, which is 2.1% of total gross credit. So assuming all the SOEs stop paying the banks, the banking sector will still be fine. Right? It's 2.1%. Transnet 36 billion, Eskom 26 billion, the IDC 13, SAA 12, Trans-Caledon Tunnel Authority 12, Telkom 9, Landbank 5, Sanrail 4, etc., etc. Foreign bank branches in South Africa have 104 billion rands worth of credit exposure to the SOEs. I won't mention the numbers, but Citibank, HSBC, JP Morgan, China Construction Bank, Stanchart, SocGen, Deutsche Bank, all have some exposures. Total exposure from the local government and municipalities to the banking sector is 28.8 billion rand, of which Johannesburg is the largest at 8.2, Tshwane at 6.2. The point I'm making is that these are relatively small proportions of a 5.5 trillion rand sector. Right? So even if they all don't pay a cent back, it will hurt the banking system, but it will not destabilize the banking system. And this is direct exposures. Chair, if you don't mind, let me deal a little bit with what we call single name exposures. When we meet the banks, we discuss single name exposures. Some of them have been there for a few years. Some of them are obvious. Sort of Edcon was one for the last few years. We've seen names in the construction sector. More recently, as you mentioned, Steinhoff, Tongaat, Hewlett. Steinhoff was fairly big. Steinhoff's total exposure to the banking sector was around 21 billion rand, fairly big, but that's about the largest in some ways. So while there are exposures to the banking sector, banks' risk management practices, banks' concentration tolerances, and the large exposure framework at a prudential level does limit the systemic impact of these single name failures to the banking sector. If all of them fail at the same time, that's a different story. But I think we've got pretty good risk management in the banking sector. If any one or two or several large single names have to go under, it will hurt the banking sector, but it will not destabilize the banking sector.
Just to round up, be clear, so underline this. Guaranteed SOE debt ranks pari passu with the sovereign debt. So you can't do a selective default of the debt. So thinking of an SOE with guaranteed debt defaulting would basically mean the sovereign is defaulting. And I am not sure that our constitution allows us to do so, because it provides that before we allocate money to anything else, we must first provide for the servicing of national debt. So that is not an option. Any other questions?
Not for me, Andrea. Thanks.
Thank you, Governor. So I have a question that I suppose anybody on the panel could answer if you have an opinion. It relates to unsecured credit from households. So you see that this sort of broad uptrend in the last 12 months or so has come through. Secured credit is basically sideways. So is this, I know you mentioned or alluded to, Videshri, that maybe it's a bit of distressed borrowing. Maybe it's greater appetite from the banks willing to extend credit into this market because their perception is risk is improving. Or is it because maybe no one really wants to buy a home or a car, and so they want to take on credit to buy clothing or furniture or to improve their home? So how worried are you that this is really distressed borrowing versus just a traditional recovery in the credit cycle?
Are there any volunteers here? You want to delegate upwards? Go, Hendrik.
Obviously, this is a trend that we are worried about, given what happened in 2012 and the extent of unsecured lending growth that we saw there in excess of 30%. Subsequent to that, through various measures, it did come down, including some model suasion, fairly quickly. But I mean, this is also a profitable credit category for the banks, so that's possibly one reason. Whereas the traditional categories of mortgage lending are not. So that's maybe another reason. The distress lending issue is a concern, and it is something that we need to watch carefully, or the Prudential Authority obviously will watch carefully.
But he said this, no, I'm not sure that he said he meant distress lending. The South African banks are very smart. They will not do distressed lending. You meant distressed borrowing.
The same thing.
Fundi and then Videshri.
The challenge with unsecured lending, Andrea, is you can't, it's not classified in the real way, in a proper way. So it could be SMEs that are borrowing using this channel. So if you get an SME that is run by an individual and they go to the bank for a loan, so because you can't classify the debt, you can't tell what it is for. And it certainly is, as Hendrik mentioned, a lot easier to get that type of credit when you go to the bank. Some households utilize this for renovations. You can't tell, is this a renovation? Is it to pay for school fees? And is that different from other categories of consumption? So to that extent, that is a challenge that is there in terms of what is the unsecured financing being utilized for.
Videshri?
Just wanted to add that the one sort of category I did not show on that slide, but it is in the FSR, is the fact that there's also been an increase in consumption expenditure. So more on the distress side, so we will be watching that closely, especially if consumers are using a credit card to pay off a credit card. So that's just one aspect.
We have a box. Oh, we also have a box in the in the FSR where we've tried to give some more color in terms of what we are picking up.
Katu?
Hi, Governor. Just to elaborate on that question, I just wanted to find out, does the
I
SARB
expected you to answer the question.
next time, does the SARB have any tools that they're willing to use should the unsecured lending maybe reach levels that they feel is then maybe risking financial stability?
Yes, we do, of course.
Can
And
you
all
name
of-
some?
And all of those tools are in the micro thing. We could change capital adequacies. We could look at all the instruments are micro instruments, and we could get to that. But I just wanted to say that I am not as concerned about the increase in unsecured lending as some of you would be, because there was a time when we were concerned that unsecured lending was rising very fast. Then we turned and we complained and said that the banks would not lend to you unless you have a collateral. Now we are coming back, the banks are lending without a collateral, and we are saying we are concerned that you are lending to people without a collateral. So it is not quite clear what we are looking for. And I will tell you why I am not as worried, because you talked about distressed lending. Because you see, what we have just, these amendments that have just been done to the National Credit will make sure that no lending actually takes place in there. And if industry was to be believed, if you had what they would said is that, well, where you have put place that threshold, what that basically means is that as the regulated sector will not lend to those borrowers. Does it mean that those borrowers will stop borrowing? No. They are going to go into the unregulated sector, and that is what we should really be concerned about, and the social consequences thereof. Unati, do you want to add something to your micro instruments to deal with any increase of any category of debt that you feel you don't like? Because you see, if he doesn't like a rise in housing prices, he changes the loan-to-value ratio, you see. But let's hear.
Thank you very much, Governor. So you're quite right. So there's a list of tools that we can apply to different categories of lending. Capital adequacy, obviously, is being one of them. Risk weighting, a particular category of exposure, being another. Dynamic provisioning as well. So there is a list. Actually, there is a paper that the Financial Stability Department published on the list of microprudential tools which can be applied at a macro level if there is a concern with any category of lending or any category of institutions that have a particular activity that we think is posing systemic risk.
Thank you. Any other questions? Okay. Panel, you got away very lightly. Rashad, is there any question that has not been asked that you would like to answer?
Okay. Maybe I can just do one quick thing just to say that we, like many central banks, are trying to grapple with how we think about the consequences of growing debt, whether in the government sector and the household sector, for financial stability. Often it's not straightforward. Often those links are not clear-cut. One of the things we're striving internally to really do is to continuously work at refining the financial stability report to really get to the heart of what are the pressure points and risks that we see. And we undertake to kind of continue
to improve on this, and your feedback could be really useful on what you think was a major omission, what you think you'd like us to focus on. So just to say that we all, like many central banks, recognize the importance of really doing very serious analysis about understanding risks in the financial sector, banking, asset markets, but we're often not very clear-cut about what this means for financial stability, but so are many other central banks. So this is a challenge we set for ourselves, and look forward to more engagement with you on these issues.
Well, thank you very much. That concludes the proceedings. You could still continue to interact. You know, if we were in the central bank, you will get an abundance of liquidity. But we are not at the central bank, but there is borrowed liquidity outside.